This video describes the composition of three major sectors of the U.S. financial market and proceeds to describe the performance of the sectors from the investor's perspective. The sectors are the money market, bond market, and equity markets. You may be familiar with some or all of these terms, but not with the specifics of the instruments and how they trade in the market. We present each one by one. The complexity of the financial market can be seen by the specialized language used to describe it, and often there's more than one term used to describe the same market or instrument. The key terms at the end of this are essential to understanding the chapter from Openstax Finance, Chapter 12, The Historical Performance of U.S. Markets. U.S. financial markets are complex, broad, deep, and dynamic. The structure of the financial market helps you understand the various instruments traded and their purposes to issuers and investors. One way to parse out financial markets is by the instrument maturity. Financial markets can be classified by their maturity as short, medium, and long term. Short-term instruments make up the money market. Medium and long-term instruments constitute the capital market. The money market finances short-term needs, and the capital market is focused on debt and equity. That's used to finance longer-term capital needs. The capital market can be divided further between debt instruments and equity instruments. IPOs, or initial public offerings, or SPACs, otherwise known as special purpose acquisition companies, help raise new equity. Most trading occurs on organized physical exchanges, or OTC, or over-the-counter virtual markets. These together are called the secondary market. What determines a money market instrument is its maturity, which is 1 year or less. Commensurate with the short maturity, money market instruments are normally low risk. The primary issuers are the U.S. government through T-bills and private sector entities through commercial paper. Banks also do this through CDs, or certificates of deposit, and federal funds. Examples of money market instruments include money market mutual funds, ETFs, T-bills, CP, NCDs, and Fed funds. ETF stands for exchange traded funds. T-bills, the T stands for Treasury. CP is commercial paper. Negotiable certificates of deposit, or NCDs. And Fed funds, the Fed stands for federal. The bond market can be segmented between the U.S. government market at the federal, state, and local levels and the corporate market. The similarities and differences between the two are presented here. Note that it's important to recognize the importance of taxes as the feature of government bonds, particularly from an investment perspective. A corporate bond investor will pay federal, state, and local taxes on any interest received. However, the owner of a government or municipal bond will pay only some or perhaps none of these taxes on the interest. There is a tax advantage, so federal and muni bonds are attractive to investors, especially those in higher tax brackets. Both the U.S. government and municipal governments and their agencies are active debt issuers to finance new public projects as well as refinance existing debt. Segments of this include the category, maturity, instruments, money market, depending on these up to a year, treasury bills, commercial paper, federal funds, CDs, and bankers' acceptances, notes for 1 to 7 years, treasury notes and MTNs or medium-term notes, and bonds are over 5 years, and corporate municipal U.S. government bonds are also that same time period. The essence of bonds is straightforward. The issuer-borrower borrows in the public market from investors or lenders. The issuer pays interest, rent of a sort, to pay the lender for the use of its funds. The sum borrowed is repaid at the stipulated maturity date. Cash flows from the bond are clearly identifiable, unlike stock. If the bond is held to maturity, investors know exactly how much they will receive in interest and principal. The issuer knows exactly what must be paid out. Bonds become complicated when a bondholder sells the bond to another party before maturity. At that point, the value or price of the bond will change from its original issue price, normally $1,000 for most corporate bonds, to something higher or lower than its face value, depending on market and economic conditions. You may wonder why a corporation might decide to raise external financing by issuing bonds rather than stock. Note that when we discuss financial statements, bonds are normally the preferred funding source over stock because of the treatment of interest on the income statement. After a company's operating profit is determined, it deducts interest expense to arrive at pre-tax income. Taxes are deducted to arrive at net income. Interest is tax deductible. Dividends are not. Debt financing then becomes the preferred choice over stock. The origin of the bond market goes back to Renaissance Italy, where warring regions sold their IOUs to the local residents. This reduced the local duke or prince's need to raise taxes or borrow from the early banking families. Bonds predate stock by about 100 years. For more information, read Ferguson's The Ascent of Money, A Financial History of the World. In 1980, there were 80 U.S. companies with a AAA rating, the highest possible. A AAA rating is a sign of financial strength. Today, there are only 2 such AAA companies. This would not seem to be a random event. Instead, the trend is purposeful. Why would a company choose to conduct and structure its business away from a AAA credit rating? You can find out more information given the website below from wallstreetinsider.com. The first joint stock company was launched in 1602 when shares in the Dutch East India Company were sold. In the U.S., Philadelphia claims the first stock exchange, but New York quickly overtook it in terms of importance. Others followed. Today, when private companies need greater funding to grow, they turn to the public markets by issuing stock. This requires the company to comply with securities regulation promulgated to protect investors. It also avails the company of the worldwide equity market. The first time a company sells its stock is known as an initial public offering or IPO. These events are known as the primary market. After shares become publicly held, they can be traded easily in the secondary market. Note that a well-functioning secondary market is essential for the success of a primary market. Most traded shares are common shares. Common shares, or Class A shares, represent partial ownership in the issuing company and entitle the shareholder one vote on major company matters. Note that Class B shares are preferred shares. Sometimes there's a Class C. Note a difference between common or A shares and preferred B shares is voting rights. While common stock follows one share, one vote rights, preferred shares normally have voting rights as a multiple of each share, sometimes 10 to 1. This is often found with companies founded by an individual who seeks to retain voting control of the company. SPACs are a new method of going public rather than the IPO. The financial sponsor holds significant capital available to acquire a target company. They merge with the target company, with the target remaining as a surviving company. Transactions are consummated quickly. The purchasing company normally doesn't pay a significant acquisition premium. Note that there is controversy regarding securities regulations. Investors can place orders to buy or sell securities through brokers or dealers. Full-service brokers charge transaction fees depending on the extent of services provided. Low or even no-fee transactions have become popular, and retail investors have become a more influential portion of the investor market. A market order is an order to buy or sell a stock at the market's current best available price, and a limit order puts constraints on the price to buy or sell. Figure 12.4 describes the order of payments for trade executions. The customer instructs a broker to execute a stock trade. The broker sends the trade in to a wholesaler and collects a fee. The wholesaler finds the best deal or the lowest price or speediest trade. The wholesaler then returns the proceeds to the broker. The broker then credits the customer, and the process repeats itself. Inflation is the rise in general price level of goods and services. Commentators going back as far as Copernicus have opined about the money supply inflation causation. The Fed considers moderate inflation rates optimal. Stable prices is one of the 4 goals of U.S. federal economic policy as promulgated in the Employment Act of 1946. The consequence of inflation is an erosion of the purchasing power of a country's currency. Inflation is measured by comparing the price of a representative basket of goods over time. Since not everyone consumes similar baskets of goods, there are several different measures of inflation. The most commonly quoted measure of inflation uses CPI, as it measures price changes that affects individuals. An example from real life is the following. A loaf of bread cost a nickel in 1911. Today you would pay about $4 for a loaf. The nature of a loaf of bread hasn't changed in 100 years, nor has the method to produce one. The cause is predominantly inflation. Similarly, but in the next generation, a more robust example would be to explain that the CPI is a sample of goods in 8 categories commonly used by individuals, and the US BLS, or Bureau of Labor Statistics, tracks changes in this basket of goods monthly to gauge inflation. For more information, go to macrotrends.net and look up the USA country in terms of the CPI inflation rate. The impact of inflation is felt in very tangible ways. Nominal wages have compounded annual growth of 5.7% over the past 40 years. If adjusted for inflation, however, the real wage increase is barely above zero. Most wage earners have seen almost no real increase in their purchasing power over the past 40 years. Actual inflation can only be seen and measured ex post. Great attention and analysis are paid to estimating future inflation. This can only be estimated. Financial institutions, corporations, and academics build elaborate sophisticated models using monetary and fiscal inputs to make these estimates of future inflation. Long-term trends show inflation in the U.S. has averaged about 3%. However, there was a material spike in inflation between 1974 to 1983. Due to the lower risk profile of bonds compared to stocks, returns are also lower, meaning the lower or higher the risk of certain bonds, the lower or higher the return. This is the risk-return relationship. Bond prices and returns can vary considerably, however. This is due to changes in market conditions that in turn cause bond prices and yields to change. The bond performance varies based on the credit of the bond. Our bond returns are volatile. See the information from text from Aswaf Damodaran's online data. The inflationary condition of the early 1970s and the Great Recession of 2007 through 2009 impacted bond returns markedly. The national government issues sovereign bonds, but that does not mean they do not carry risk. Sovereign bonds have defaulted, some several times. U.S. government bonds are considered nearly default risk-free. Though very safe, U.S. government bonds have shown considerable return volatility due to market conditions. Pervasive inflation in the early to mid-1970s was vanquished by strong monetary policies by then Fed Chairman Paul Volcker. Sovereign returns responded forcefully through much of the 1980s. They drove up average annual returns in the 1980 to 1999 period to comparatively high 10.21%, leading to less volatile returns in the 2000 to 2020 periods reflect lower prevailing interest rates, with the major exception of monetary stimulus during the Great Recession. Overlaying the figures with the BAA bond performance from the 80s, 90s, and 2000s, on top of the Treasury bond performance during the similar periods, you would see a correlation. Varying degrees, market factors caused sovereign volatility also drove corporate volatility. Another way to think of this is that the more risk corporate bonds generate, the greater returns for investors. Also, market conditions move the returns of both sovereigns and corporates similarly. Stocks have produced the largest average annual rates of return among the money and capital market assets discussed. Stockholders bear more risk than bondholders or money market investors and normally receive higher average annual returns. Despite the relatively high average annual rate of return for portfolios of stock, history shows that the equity markets earn negative annual returns about 25% of the time. A rich source of historical equity market data can be found at macrotrends.net/chart/stock-indexes. The data is open source and is made up of graphs depicting various time periods, index comparisons, and political periods. Higher risk instruments generate higher returns to investors than low risk instruments. Small cap stocks generally follow this pattern when compared to large cap stocks. Small caps outperform large caps in nearly every year since 1980, except for the dot-com market bubble correction. The previous chart had a fairly normal distribution, with the highest stack representing equity returns between 10 and 20%. Greater or smaller annual returns slope away from the median. This was the pyramid of equity returns distribution of annual returns for the S&P 500 from 1920 to 2020, according to Aswaf Damodaran online. An investor would seem to have a greater chance of a 10% to 20% return in any random year. This is a reasonable starting point for forecasting equity portfolio return. The returns for 52 years were 10% or higher. A 10% annual return shouldn't be assumed, however. The return for 40 years were below 10%, and 10 years showed negative annual returns. Thanks for watching and listening to this video. Please like and subscribe for more content.